All week, we've been looking at these beaten down apparel and footwear stocks, trying to figure out which ones can make a comeback. This group has been hard hit, in part because it's hostage to the consumer, and in part because it's right in the crosshairs of President Trump's tariff agenda. On Tuesday, I highlighted VF Corp, where I want to wait for more evidence of a turn before I feel confident sticking my neck out. Although it's certainly encouraging to see a bunch of insider buying recently of late, including from CEO Bracken Darrell, who plunked down $1 million the other day to buy shares in the open market. That's conviction. Yesterday, I told you I'm cautiously optimistic about Lululemon's ability to keep rebounding, assuming that they don't drop the ball when they report next week. Tonight, we need to talk about Nike, arguably the most controversial stock in this corner of the market. For decades, Nike was one of the greatest growth stories around, but then it became a house of pain over the past 3.5 years. The stock peaked at $179 in November of 2021. Since then, it's been all downhill, plunging to $52 at the post-Liberation Day lows, although it's now rebounded to the low 60s. Basically, Nike's now trading at the same level we saw during the pandemic era lows in March of 2020, when the entire economy was shut down. Now, Nike's had some serious problems over the past few years. At first, when the stock started pulling back from its highs, many thought it was simply cooling off after a huge run in 2020 and 2021. But then the stock started rolling over again in 2023. The bulls said that was about their huge exposure to China, where the economy was still struggling. As the market kept climbing, though, Nike just kept sinking lower and lower, and it became impossible to deny that there were serious structural problems here. For example, under the leadership of former CEO John Donahoe, the company went all in on its direct-to-consumer business, and in the process alienated key retail partners, which ended up hurting Nike. At the same time, management lost focus on the signature product innovation that had powered Nike's rise since the 1980s. Competitors started swarming, everyone from On Holding to Hoka to New Balance to Lululemon and Vuori. And Nike did a poor job of defending its market share. All of this led to consistently weak numbers, to the point where Donahoe was forced out last September to be replaced by a much liked, not loved, Nike veteran Elliot Hill, who came out of retirement to try to turn things around. Now, given the scale of the problems here, I don't think Hill's had enough time to deliver a comeback. When Nike last reported in March, the results were solid enough, but management also hit us with a pretty dour outlook, talking about a revenue decline in the low to mid-teens for the current quarter. Wow. With a 400 to 500 basis point decline in gross margins. Oh, man, that's terrible. This is the second time in a row that Nike's blessed us with ugly guidance under Hill's leadership. And, of course, that last quarter in March came about 2 weeks before the Liberation Day tariffs announcements, which sent the stock lower still because they do the vast bulk of their manufacturing in Southeast Asia. But once the tariffs started to get rolled back or paused, especially the most egregious tariffs on Chinese imports that got reversed 3 weeks ago, Nike was able to rebound off its lows. It's now about $10 above its early April bottom and essentially back to pre-Liberation Day levels. So could this be the start of a larger move higher? You know, honestly, I'm conflicted on Nike. On the positive side, the new CEO has a clear strategic plan to turn things around by focusing on running, basketball, football, training, and sportswear, especially in the United States, the United Kingdom, and China. I think that's smart. Better to nail their best categories in their best markets than try to be everything to everyone. Earlier this month, Nike also announced a series of senior leadership changes, including the retirement of the company's former president of consumer, product, and brand, with her responsibilities now being split across 3 separate executives. Definitely needed some fresh blood there. Then just last week, we learned that Nike plans to start selling its products directly on Amazon again for the first time since 2009. That's important, not just because Amazon will bring in more business, but because it shows you how the company's strategy has changed. Rather than going all in on their direct-to-consumer business like they did under Donahoe, Nike's once again trying to work directly with retailers to bolster its sales. They also did a terrific partnership with Red Hot Urban Outfitters. Very shrewd. That conference call with Urban Outfitters, so much of it was about Nike. Finally, I simply think that the stock is more de-risked than it's been in quite some time after 2 consecutive kitchen sink quarters where management did everything they could to reset expectations. In late June, Nike reports again, and hopefully after clearing out bad inventory over these past couple of quarters, the company won't have to pair its results with another tepid outlook for the future. Plus, if the guidance is really okay this time, not even good, I bet some analysts will start to come around because a number of them seem to be itching to upgrade the stock. All that said, while there are real positives here, including indications that China's actually stronger than you would expect, I find it hard to get too bullish on Nike because this brand just ain't what it used to be. In particular, I worry about the competition in athletic footwear, which has long been Nike's bread and butter. Unfortunately, the old regime dropped the ball just as On and Hoka took the world by storm. Hoka, by the way, owned by Deckers. By focusing so much on its direct-to-consumer channels, Nike was, in effect, building barriers to its brand, and consumers established loyalty with these other brands. It also didn't help that Nike got pretty aggressive with its pricing, which made its merchandise too expensive for many of its customers. I think Nike can win it back, But it's not going to happen overnight. Under the old regime, Nike stopped sending its latest and greatest merchandise to Foot Locker. That's a key distributor. And that opened up slots for the competition at Foot Locker. Nike repaired that relationship just in time for Foot Locker to be acquired by Dick's, but a lot of damage has been done. So here's where I come down on Nike. I believe it can mount a comeback, but I also think that a meaningful, complete turnaround could take a longer time than expected. If you're tempted to play a turnaround here, and I don't blame you, I would start with a small position. That way, if something else goes wrong, you can buy more into weakness, pyramid style, or you can just cut your losses. And if Nike reports a good quarter with healthy guidance next month, well, you'll get a chance to capture some upside. The bottom line, I am optimistic that the worst is indeed behind Nike, or at least will be soon. And I think there's a good chance for a comeback, especially with a seasoned, hands-on Nike veteran like Elliot Hill at the helm. That said, I don't have a ton of conviction in the turn happening quickly, so I'd advise you to start slowly with a small position and only buy more if Nike gives you a good reason to pull the trigger. Let's take some calls. Let's go to Bill, Massachusetts. Bill.
Hi, Jim. Thanks for taking my call.
Of course.
I have an equity here that's $9.5 billion in revenue, and they have a gross profit margin of 31%, which is paid out in dividends, which I know you love. It's Dick's Sporting Goods.
Oh, I like Dick's very much. And, you know, a lot of people, that's both Ed Stack, but don't forget Lauren Hobart. Lauren Hobart, CEO, is fantastic. A lot of people think that they stubbed their toe when they bought Foot Locker. I'm going to say the opposite. I'm going to say that they may have stubbed their toe, but this stock is so much down. It was at 254, now it's at 181. It more than reflects they can write off Foot Locker right now. And frankly, of course, they don't need to. It would still work out. Buy Dick's Sporting Goods. I like that call. Thank you very much. Now let's go to my home state of New Jersey. Donald in New Jersey. Donald.
Hi, Jim. How are you? Jim,
I'm doing good.
I'm thinking of buying AutoZone. This will be
no, you're not thinking of buying. You're going to buy. This is the single best buyback. The quarter is very good. I am actually surprised that the stock isn't up even more. It sells at only 24 times earnings. It's consistent. They bought back half the float. You have a winner in AutoZone. All right. I am optimistic about Nike, but start small, though, and only get in if the company gives you a real good reason to pull the trigger. I think you'll get a chance. Now, there's even more retail ahead on Mad Money. I'm sitting down with the CEO of Gap, fresh off the company's report. Then last night I spoke to NVIDIA CEO Jensen Huang after the posting. After he posted a stunning quarter, one of the most stunning I've ever seen, frankly. But Jensen had some important things to say when it came to banning U.S. chips in China. I'm giving you my takeaways, and I had a little bit of change of heart on this. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.